Hey, what is up everybody? Welcome back to another video, and in today's video I'm going to be teaching you guys how to actually trade a silver bullet. Now in the trading industry, the silver bullet is presented as this 100% win rate trading model that anybody can follow and requires minimal effort. But you following this idea of the silver bullet being this easy to follow model is causing you to lose. So today I'm going to show you how to actually follow through with it. Now, the number one reason that you're failing with the silver bullet is because you have no directional bias. You see it as a mechanical template where you see a sweep of a previous hour high or a sweep of a previous hour low and then an MSS and a fair value gap, and then you just take an entry. But this isn't how you're supposed to trade a silver bullet. You need to have some context as to what will happen within the silver bullet hour. Ultimately, you need to know what happened in the hours before and where price is headed. You do not need a long-term bias, yet simple basic knowledge of OHLC, which I'll cover later, and basic knowledge of PD arrays is key. And the second reason and the final reason is your entry method isn't sufficient. So the majority of people trade market structure shift fair value gap, but there's other better methods to trade the silver bullet, such as the unicorn model and also the inversion fair value gap SMT model. So what is the open, high and low close? So the open, high, low close is how a candle forms. Now for a bearish candle, what you'd normally expect is for the candle to open, for it to make the high of the candle first, for it to expand, and then to make the low of the candle and then close. So basically the first end of the candle is opposite to the expansion of the candle, and the bottom end of the candle will be formed at the end of the expansion. At the start of the candle, you can expect it to accumulate, then manipulate, and then distribute. Here is an example where following the silver bullet mechanically would have actually caused you to lose. So as we can see, we had a sweep of the previous hour high. Now, the majority of people would have seen this sweep, and they would have seen this market structure shift, and they would have taken shorts off of this order block. And what would have happened is their stop loss would have been hit. Now, the people following the silver bullet in this way are losing for a very, very good reason. And I'll tell you why. They're not following the silver bullet with context. They're following it as a blueprint. So look, what's the market done before? The market's obviously in a bullish trend. It's swept liquidity, it's manipulated downwards, and it's expanding upwards. So we can expect the market to continue trading upwards in this hour. Now, as we can see over here, what happened was we had a significant draw on liquidity from the previous day high, and then we had a big expansion to the downside. Now, the average silver bullet trader would have traded market structure shift and then a fair value gap. But what would have happened is they wouldn't have been filled, because look, we had a market structure shift leaving a fair value gap over here, and the market never returned to fill in that fair value gap. It just kept continuing downwards. Now, what they could have taken instead is a simple SMT and inversion fair value gap entry. So look, we had this fair value gap over here, we closed below it, and what happened was we clearly inversed this, and this fair value gap wasn't being respected. And because this fair value gap wasn't being respected, we could have expected the market to continue moving downwards. As we can see, we inversed this fair value gap with a lot of momentum, so we wouldn't even need an SMT to confirm our entry. And we could have taken shorts off of this inversion fair value gap by setting a limit order over here, putting our stop loss above that high over there, and targeting sell side liquidity. And we could have bagged a nice 1 to 4 just like that. So let me go ahead and play it for you guys. Price comes back to fill us in. And eventually we hit take profit. Now in this silver bullet, as you can see, the market in the previous hour came down and it took this low over here, and it rejected heavily off of this order block over here. And we also inversed this fair value gap with a lot of momentum and gave a market structure shift. So we expected the market to continue going upwards. With our narrative of now being bullish, we can now take an entry within our silver bullet period to catch a continuation trade going upwards. As you can see, we give another break of structure to the upside, come back into this breaker block, which was responsible for sweeping all of this liquidity. And this breaker block is within this imbalance, along with this other small breaker block, and we could have taken a trade, showed some rejection. As you can see, that candle showed us clear rejection and the market's intention of moving upwards. So we could have taken a long from there with our stop loss below this low over here, because that's where I see my trade getting invalidated and where I want to get out of the market. And we could have targeted this high over here. And as you can see, the market just shoots straight up to our take profit. Now, this entry method is the best entry method for the silver bullet. Now, usually the silver bullet follows the trend and it doesn't take the previous hour or previous day low and then continue upwards. So what you'd want to do in the silver bullet is actually take a continuation trade. And the reason the breaker block FVG entry or also the unicorn entry is good for that is because it's a continuation based entry model. So the first thing you want to look for is a breaker block. So what is a breaker block? A breaker block is when you have a market structure shift to the downside and then you have a market structure shift to the upside. So what does that look like? We have a low, we have a lower high, we have a lower low, and then we have a higher high. And our breaker block would be the up close candle within that peak over there. So we'd mark that out and then we'd find a fair value gap that that's engulfed within the breaker block. And then what we'd want to do is either set limits at the fair value gap or wait for rejection and then take a market execution off the rejection, targeting highs. Usually we'd want to place our stop loss between a key PD array or beneath this low or another key low. Now guys, that's the end of the video. I hope you guys enjoyed. If you did enjoy this video, please leave a like and subscribe guys. It really does help my channel. And if you want any personal or private support, please go ahead and join my Discord server and just drop me a message and I'll answer whatever question you have. And yeah guys, thanks for watching and bye.